Good morning. This is Bloomberg Daybreak Europe. Happy Friday, everyone. I'm Tom McKenzie in London. These are the stories that set your agenda. Investors turn cautious after a barrage of weak data on the US economy. JP Morgan's Jamie Dimon tells Bloomberg that he, quote, would not take a recession off the table. President Trump rounds out his Middle East tour with another $200 billion of deals. But China hawks sound the alarm over advanced AI chips ending up in Beijing. Plus, hopes fade for a Ukraine ceasefire as the US Secretary of State downplays expectations for today's talks in Turkey. President Trump says nothing will happen until he meets with Russia's Vladimir Putin. Check in your markets then. Currently, futures in Europe pointing to modest gains, as you can see, of about 0.1%. Here in the UK, the FTSE 100 pointing to upside, also of about 0.1%, looking to add about 11 points so far in the session. S&P 500, you had a broadening out of the gains yesterday, which to some, at least in our MLive team, suggested a more healthy market reaction stateside. Currently, though, futures largely unchanged. Looking for the next catalyst, you are just 4% away from a record high, once again, from the S&P 500. What a year to date it's been for that index. Nasdaq 100 futures currently flat as well. Meta was the drag yesterday, even as you saw that broadening out. Meta not releasing its latest model, at least reports that it's going to delay the release, and that led to softness for that stock. Let's flip the board and have a look cross asset. The other notable action was in the treasury markets, with yields falling pretty significantly, down about 10 basis points on the US 10-year. Towards the back end, you saw still yields up, closing towards that 5% level. So it's towards the front end where you saw the money moving into treasuries on that raft of soft economic data, whether it was prices paid to producers in the US falling the most in about 5 years, or softer retail data as well. Factory data also coming in a bit weaker. So that softer economic data leading to a rally for treasuries, with yields coming down, particularly at the front end, even as the long end remained relatively higher when it comes to yields. The benchmark 10-year currently yielding 4.42. Euro dollar at 1.12. Markets, by the way, now pricing in 2 cuts this year from the Federal Reserve. 1.12 on euro dollar. The single currency up 0.1% on softness around the dollar. 64.82 right now for oil. Up 0.4%. Iranian officials coming out and pushing back, it seems, on some of the recent reporting optimism around Iran and US on a potential deal. So watch that in terms of the impacts on the oil markets. Gold lower in the session by 0.6%. Let's check in briefly on the Asian market action. You've had softer GDP out of Japan. In fact, a contraction, the first contraction in 12 months for Japan. The Nikkei is currently unchanged. The Japanese yen remains in focus. Reports that currency discussions could again come up between Japanese officials and their US counterparts. 145 right now on the Japanese yen, a move of 0.3%. We continue, of course, to monitor the Korean won as well on that FX story, and whether we got more clarity indeed as to whether or not this Trump administration ultimately wants a weaker dollar. Across the benchmark in Asia, again, that search for direction largely unchanged so far in the session. Let's get back to what's happening in the Middle East then, because US President Donald Trump has secured $200 billion in deals during a visit to the UAE. The agreements include investments in AI, aircraft, oil and gas, as well as metals projects. The deals build on a pledge from Abu Dhabi to invest $1.4 trillion in the US over 10 years.
We have now, I think, substantially over $10 trillion of investment. And now when they add the $1.4 trillion, we easily break that number. So that's investment or investment that we think will soon happen.
Well, for more on this, let's go to Dubai and bring in Jumana Pasechi, Horizons Middle East and Africa anchor, who, of course, has been following the Trump visit and hopping from place to place to do so. More big deals then, Jumana, this time from the UAE. Talk us through the highlights in terms of what the Emiratis have agreed to.
Yeah. So one thing I actually observed when thinking about the recap of this week is every country he went to, the economic pledges just went slightly higher. So $600 billion was the commitment from Saudi Arabia, the Crown Prince pledging to increase it to $1 trillion. Then he continued on to Qatar. There, the economic cooperation figure was $1.2 trillion. And then, of course, now he's in the UAE, and the figure there is even higher at $1.4 trillion, pledges of investments over the next 10 years. Now, it is important to note that these are pledges. There's a difference between a pledge and deal. deals. In terms of actual deals, inking about $200 billion worth in the UAE, announced yesterday evening. Those include around a $14 billion agreement between Etihad Airways and Boeing, so Boeing getting more deals from the UAE. A partnership announced between ADNOC, the UAE state oil company, and many other U.S. American companies as well. That's worth about $60 billion. But then the major headline, and I think this is going to speak to you directly, Tom, because it's right up your street, AI. So President Trump has signed deals to create a 10-mile AI campus. That is really going to be an integral part of AI's ambitions to become a global powerhouse in the AI space. They say it's going to have up to 5 gigawatts of capacity. You and I were speaking about that offline. Essentially enough power to power 4 million homes. There has not been any other campus of this ambition. And it tells you a lot about, one, GCC's own AI ambitions, but also how the U.S. are partnering up with the GCC countries to help achieve those ambitions, because crucial to that is them getting access to some of those high-tech chips that we've been speaking about. The Trump administration have loosened the requirements in order for these countries to get access to those chips. And by the way, we put out a story overnight on the terminal saying that some people within the Trump administration are a little nervous as to what the watering down of those rules means, and ultimately still have national security concerns. But it became very apparent from this trip, Tom, that President Trump wants to work with the Gulf allies and helping them with those AI ambitions that they have.
Yeah, it feels like we could look back on this moment as really laying the foundations for that AI revolution within the Middle East, with all the talent and, of course, some focus that's been there, of course, over the last few years, and a big pivot this time over these deals. Horizon's Middle East and Africa anchor Jemana Pasechi with a fantastic wrap there. Thank you, Jemana, of course, for all the work throughout the week as well. Now, President Trump's Middle East tour has, of course, seemed more about business than geopolitics, but the US president still mentioned Iran a number of times, saying a nuclear deal with the Islamic Republic could be getting closer. One state notably absent from his tour has been the US's closest ally in the region, Israel. Let's bring in Jane Kinninmont, acting director at the European Leadership Network. Jane, with all that deep experience you have on the Middle East, talk us through what you've seen from this Trump visit, what we should understand from the elephant in the room, as we could characterize it, around Israel. Its absence in terms of what we heard from President Trump, barely mentioned, if at all, and the fact, of course, he didn't touch down in Israel during this visit to the Middle East. What do we take away from that?
Well, that is very significant. You know, this is his first major foreign tour. And to some extent, I think it is about theatre and PR. Trump wants this to be a tour of success. He wants it to be a tour of good news, where he comes back with very, very large numbers in terms of deals or pledges, as you pointed out. And where he can show himself being lavishly feted around the world. And he doesn't think that going to essentially a war zone and being involved in the complexities of the Gaza conflict is going to make him look good. But there are deeper things going on there. There is the fact that compared with Trump's first term, the opinion in his support base is undergoing what seems to be a generational shift in opinion towards Israel. It's partly because the younger generation of MAGA folk just aren't as interested in helping allies overseas. And that is really being accelerated by the images that are coming out of Gaza, making many younger generation Americans think, why are we actually involved here after all? Finally, seems like there's a bit of a personal rift between Trump and Netanyahu at the moment. Netanyahu's not happy with the Iran talks. He's not making any movement on Gaza. And let's remember, you know, the Gaza ceasefire back in January, it involved Biden as well, but it is the first ceasefire that Trump took credit for. His special envoy, Stephen Witkoff, was one of the key people who got that over the line. It fell apart and nothing seems to be bringing it back. So I think that seems, you know, frustrating for Mr. Trump.
And those divisions within the Republican Party and Trump's base are interesting, aren't they? Jane, I want to play a soundbite right now from Tom Fletcher, the Undersecretary General for Humanitarian Affairs, speaking to the UN Security Council in a damning speech earlier this week, where he condemned Israel's blockade and military actions in Gaza. Let's take a listen.
For more than 10 weeks, nothing has entered Gaza. No food, medicine, water or tents. Hundreds of thousands of Palestinians have again been forcibly displaced and confined into ever-shrinking spaces. The ICJ is considering whether a genocide is taking place in Gaza. It will weigh the testimony that we have shared, but it will be too late.
So Tom Fletcher there, warning of a potential genocide in Gaza. Israel criticising those comments of the deeply respected British diplomat, of course, former British diplomat. Israel arguing that the blockade is necessary as a measure to prevent aid from being diverted to Hamas. Jane, what is the situation on the ground right now in Gaza?
Well, it's really dire, since Netanyahu basically changed his calculations a few weeks ago around the value of the ceasefire. Israel has reimposed this blockade on a country that, on a part of the world, rather, of course, they're not a country, and that's the whole point, on an area that was already devastated, where people are malnourished, have no access to health services, and, generally most people have lost their homes. Hunger is getting worse and worse. International journalists obviously aren't allowed in, but we are seeing from local journalists and from mobile phone footage and some humanitarian agencies just probably a small glimpse of what is going on. And, I think there is increasing despair in the UN system and the humanitarian system because warning after warning is not heeded.
Where does this go from here, Jane? We've seen over 100 casualties, over 100 deaths this week, according to reporting. 2 hospitals have been targeted by Israel in that territory this week. It seems that Netanyahu is preparing for a further offensive. What are the guardrails at this point? Where does this conflict go from here?
Mr. Trump is one of the few people who could make a difference because whether or not he's having a spat with Netanyahu, he is the key external influence on Israel. And at the end of the day, from watching the debate inside Israel, I think there is a shift of opinion and a sense that it is time to go back to diplomacy and a negotiated release of the Israeli hostages. Numerous mainstream Israelis, from the security establishment to some of the hostages that were released during the last ceasefire, have said it's time to stop. And the reason that the war is still going on from a political point of view, it's not really being driven by the Israeli Defense Forces advice now. It is driven by the coalition politics in Israel, where when Netanyahu does his electoral maths, he is very dependent on the most extreme members of his coalition who say quite openly that they would like to occupy Gaza, that it should be completely destroyed, and the Palestinians should, as many as possible, leave to third countries so that that land can be left to Israel. That doesn't represent mainstream Israeli opinion, but it is what's driving policy. Now, we see the EU is trying to put some pressure on because numerous countries, including France, a long-time ally of Israel, are saying the EU now needs to review its association agreement with Israel because those trade relations are supposed to be linked to certain standards on human rights. External pressure on a country doesn't always work, but if external pressure is combined with domestic opposition, that can bring change. So right now, making it clear that there are red lines could actually interact with the trends inside Israeli politics to make a difference. But of course, it's all happening very slowly as the humanitarian situation is a disaster right now.
OK, Jane, always appreciate your insights on a week, of course, where the French president as well, Emmanuel Macron, described the actions of Israel in Gaza as, quote, shameful and a disgrace. Of course, Netanyahu and the Israeli leadership push back on that assessment from the French president. Jane Kinninmont, acting director of the European Leadership Network, thank you. We're going to switch focus, get back to the earnings story after the break. Dutch insurer Aegon announcing a €200 million share buyback. That was the focus for analysts. We're going to speak with the CEO on the firm's latest earnings. That is next. This is Bloomberg.
Next week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum starts Monday, right here on Bloomberg Television. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Happy Friday, everyone. Back to the earnings right now with Aegon in focus. And the analysts have been looking for what's happening in terms of a potential buyback. And indeed, Aegon coming out with that announcement now, then planning a new €200 million share buyback programme. That has been announced. First quarter adjusted operating capital being generated at €267 million for the first quarter. Let's bring in the company's CEO, Lard Friese, then, for a reaction to this. Lard, let's start with the announced buyback. There it is, €200 million. Is there more you can do to return cash to shareholders? What has allowed you to be able to get to this number? Is there more you can do through this year?
Yeah, good morning, Tom, and thanks for having me on the program again. We've just released a trading update, which shows that Aegon is off to a very strong start of the year. And we indeed announced a buyback program of $200 million, in addition to the running buyback of $150 million that has not yet been completed. This is a demonstration of the way the company runs, the strength of the company in terms of its capital creation, but also the fact that the operating units are well above their target levels. And we have a strong cash buffer in the holding company of 1.6 billion euros. So by and large, Aegon is doing well. It's off to a good start of the year. A lot of commercial momentum as well across most of our product lines that we demonstrated today. So we're off to a strong start of the year and full steam ahead for the remainder of the year. And all of this in spite of a lot of volatility, obviously, that we've seen.
Well, on that volatility question, Lard, you previously set yourself an operating capital goal of 1.2 billion euros for 2025. You're reaffirming that today. Is there more? Are you being ambitious? Is there caution baked into it? How confident are you that you hit that 1.2 billion in this volatile environment?
Well, we're confirming the targets that we have for 2025, and 1.2 billion is a very important one for that, for the operating capital generation. The company is performing well. We're seeing commercial momentum in most of our product lines across the globe. And as a result, and the capital creation is good, and the operating capital of the units is strong. So all in all, we believe that the company's ability to do this, in spite of the volatility and where markets are today, is allowing us to confirm those targets.
What are flows looking like in terms of the asset management business in the current quarter, and what's your outlook going ahead?
Yeah, the flows were net positive. They were slightly less net positive than they were in the same period last year because we had a special couple of large mandates that came in. But the third-party flows are positive. It's mainly due to alternative fixed income products and investment strategies that we operate throughout the UK and the Netherlands in this quarter. We saw some outflows in our joint venture partnerships in China and in France, but our own third-party business has done well, and overall it means a net positive flow profile.
What is client activity looking like within that unit right now, Lard?
Clients, of course, given all the volatility that we've seen post the quarter, especially in April, clients were, of course, quite, let's say, careful in that period of volatility. But we're seeing, especially in the alternative fixed income products, real asset products, still a good demand. And as a result, we engage with our commercial organizations across the globe quite heavily with all our clients in of course, helping them to run their assets and to gate mandates in.
Yeah. Is there more that you're prepared to do to de-risk those non-core assets in the US market?
We have financial assets, as we call them, in the U.S. markets. Those are closed blocks of business that indeed we aim to accelerate the let's say, to accelerate the runoff of those businesses. We have a lot of actions that we do ourselves on a continuous basis. Obviously, we're always looking at ways to accelerate that further. And the moment that that would be the case, we would, of course, disclose that.
You are you've signed up to the Mansion House Accords here in the UK with the pension industry then, agreeing to invest, 5% into UK private assets. This is a voluntary agreement. Is that 5%? Is that 5% realistic? Can you meet that? Are the assets in the UK available to get to that 5%? Could we have been more ambitious here in the UK? Could we have gone for 10%?
Well, the Mansion House Agreement that we are a co-signatory of is an attempt to ensure that there is more allocation and access provided to private markets, and including the UK private markets. That is something that we are actively promoting. We are creating specific funds and specific areas for that for our pension clients. And we believe that is a very important initiative because it allows our clients to diversify further and benefit from that diversification. So we are a big proponent of it. Now, there's been some talk that the pension, let's say the government in the UK would want to make this a mandatory allocation. That is something that we're not a fan of. We believe it's very important that we maintain the fiduciary duties that pension schemes have to their participants, and that this can all be achieved through a voluntary way of doing it. That is really what we are aligned with and what we believe is the right thing to do.
Yeah, in fact, the Chancellor telling Bloomberg's Lizzie Burden this week that she would not rule out completely, possibly making it mandatory. But you would push back on that. Before we let you go then, Lard, what is your outlook for the Chinese market?
The Chinese market, of course, we all know that the Chinese economy is transitioning from an export-led economy to a consumer-driven economy, and that is something that, that goes with back and forths, as we all know. The interest rates in China have been low, and as a result, this has subdued the let's say, activity when it comes to insurance products specifically. Now, this quarter, we actually saw an uptick in our sales, but our sales profile over the last couple of quarters has been quite muted, and that's a result of the regulatory changes that are taking place to accommodate this new environment. On the asset management side, however, we have a business there as well. The asset manager over the last, let's say, 12 months, 24 months has done very well and keeps doing quite well. So we're quite pleased with that. But obviously, the trade tensions and the particular transition that the Chinese economy is in is something that is reason for let's say, having a prudent eye on how that all develops.
OK, a prudent eye on how things adapt in China. Aegon CEO Lard Friese, appreciate your time on the back of the announcement around the earnings, of course, planning a new €200 million share buyback programme, that being announced. Later in the show, we're going to hear from the chief executive of the European defence and aerospace giant Leonardo. That's going to be a fascinating interview to listen into. He's going to warn, and he has warned, that we are already in a war economy. That exclusive conversation is coming up. This is Bloomberg. UK Prime Minister Keir Starmer is expected to hold talks with leaders including the French President and Commission boss Ursula von der Leyen today, ahead of Monday's UK-EU summit in London. Reports suggest EU leaders are pushing him to raise Britain's offer on youth mobility and fisheries in order to unlock a deal over market access. Coming up, we're going to check in on the markets as US economic data comes in soft. We're going to be in a conversation with Marija Veitmane, head of equity research at State Street Global Markets, how to position in this environment. We'll get that view and an analysis. That's next. This is Bloomberg. Good Friday morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Investors turn cautious after a barrage of weak data on the US economy. JP Morgan's Jamie Dimon tells Bloomberg that he, quote, would not take a recession off the table. President Trump rounds out his Middle East tour with another $200 billion of deals, but China hawks sound the alarm over advanced AI chips ending up in Beijing. Plus, hopes fade for a Ukraine ceasefire as the US Secretary of State downplays expectations for today's talks in Turkey. President Trump says nothing will happen until he meets with Russia's Vladimir Putin. Let's get you briefly onto the earnings story with a focus on the luxury space now. Crossing right now is Richemont. First-year sales, full-year sales, not first year, it's not the first year of this company, full-year sales for Richemont at a constant FX rate coming in as an increase of 4%. That is slightly below the estimates of 4.1%. So it's a soft miss in terms of full-year sales for Richemont. We're also getting lines in terms of the total full-year sales number coming in at 21.4 billion euros. That is slightly above the estimates, but in terms of the FX increase at a constant FX rate, those sales increasing 4% versus the estimates of 4.1%. We're going to get a breakdown of this. The operating profit came in a little softer, 4.47 billion euros for the operating profit for the full year. The estimates have been for 4.5 billion. We'll do a deeper dive on Richemont and the luxury space shortly with Charlie Wells. Let's get to the broader markets right now, because the adjustment and the focus was really on the Treasury market yesterday. Yes, the S&P 500 is still just 4% away from a record high. Futures for the S&P E-minis currently flat. Looking for direction, you're seeing a similar picture over in Asia as well. Nasdaq futures also range bound. European futures looking to very modest gains of just shy of 0.1%. FTSE 100 here in the UK looking to add currently 9 points. Let's flip the board and have a look cross asset. You did have a broadening out in terms of the equity story yesterday to some of the value names in the US, which has heartened some at least and suggests possibly a slightly healthier upside picture for the US equity story in terms of the fallout and the returns coming through on the back of the conversations between the US and China. 441 right now, close to 442 on the US benchmark 10-year. You saw moves of about 10 basis points. Yields lower towards the front end of the curve yesterday on that barrage of soft economic data out of the US. Euro dollar at 112, the single currency up 0.2%. Second straight day of losses for the greenback today. $64 a barrel on Brent, currently just up 0.1%. We have some comments from Iran around that potential deal with the US, seemingly pouring cold water on that, or at least adding some skepticism. Gold trading at 3,215 per troy ounce. The yellow metal falling 0.8%. Let's get a broader take on these markets. More analysis now with Marija Veitmane, head of equity research at State Street Global Markets. Marija, thank you for joining us. Where do we what is the next catalyst for these markets? It's been a remarkable turnaround. Your call that tech is the place to hide out has actually shaken out okay with the Nasdaq 100 back in bull market territory. What are the next catalysts for these markets?
Yeah, good morning. I think, I mean, maybe we can take a little bit of a step back. So what has happened in kind of previous 3-4 months? Investors started the year with really big positions in US stocks, tech, and those positions came to be checked. And investors unwound those positions. What's happening now is that we're seeing some progress on trade talks. We're seeing reasonably okay earnings season, definitely better in US than anywhere else. And investors are allocating back to quality stock, back to large cap stock, companies that can weather those shocks. And that's really kind of all roads lead to tech. So we're going back to kind of those kind of fundamental stories. And I think for as long as we're getting good tech earnings, good AI deals, that story will continue. So for us, we're kind of moving along the path as kind of we expect.
OK, I want to get your views on recession risks in the US as you talk about fundamentals. Let's take a listen to what CEO of JP Morgan had to say. Jamie Dimon, of course, speaking to Bloomberg's Francine Lacqua yesterday. Let's take a listen to what he said about recession risks.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
And then we had a round of soft data out of the US. Marija, what are your expectations of recession risks as you think about that fundamental story for US equities?
I I mean, there are kind of two answers to your question, Tom. I mean, on one hand, yes, I mean, huge uncertainty has definitely increased probability of recession. And what we're seeing is, I mean, hard data is kind of holding up okay. I mean, I won't say it's strong, but I mean, it's slowing, but it's holding up. Where we see the biggest collapses are in soft data. All the surveys, expectation, sentiment is very weak, understandably. So, I mean, in a way, people still have jobs. They worry about losing jobs. People are still spending, but they think about maybe they should cut their spending. So that's the kind of the stories that we're observing, like kind of okayish for now, and expect it to get worse. And I guess, I mean, that's very sentiment-driven. And I often say that there is nothing better, no better elixir for the sentiment as a rising stock market. So it's becoming quite circular. But on the other hand, and more fundamentally for me as a kind of equity strategist, what's really important is underlying earnings. And as we kind of talked about it again and again, quite a big substantial chunk of earnings come from tech sector. Are tech sector earnings under pressure? I mean, if we look at Q1 earnings, they were expected, expectation for tech sector were about, I don't know, some high teens, 17, 18% ahead of earnings season. Now they're tracking around 30. So tech earnings are still very, very solid, and that's what's giving market a boost. So it's less, I mean, of course, U.S. economy is super, super important, and we kind of anchor of it, but it's really tech earnings that we're watching.
OK, Marija Veitmane, head of equity research, consistent on that tech call. And it has, of course, taken a knock but come back and played out quite nicely, given where the Nasdaq 100 is right now. At State Street Global Markets, Marija, thank you very much indeed for your take on these markets, the next catalyst as well, and the earnings story. Coming up, aiming for the sky. German firm Quantum Systems hopes to take its AI-powered drones global. Talking of tech, we're going to speak to its co-CEO next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, hopes have faded for a Ukrainian ceasefire after Russian President Vladimir Putin sent a low-level delegation to talks in Turkey. President Trump says there will be no resolution until he meets with Putin.
Nothing's going to happen until Putin and I get together, okay? And obviously he wasn't going to go. He was going to go, but he thought I was going to go. He wasn't going if I wasn't there. And I don't believe anything's going to happen, whether you like it or not, until he and I get together. But we're going to have to get it solved because too many people are dying.
US Secretary of State Marco Rubio echoing his boss's comments, saying that the likelihood of progress was low without a meeting between Putin and the US president. Meanwhile, the CEO of Italian defense company Leonardo says Europe is almost in a, quote, war economy. This came as he weighed in on the continent's defense build-up and the need to create European champions to compete with Chinese and US defense companies. Roberto Siglioni spoke exclusively to us from the company's headquarters in Rome.
This first quarter, we had an increase of approximately more than 20% year over year. And in general, the financial figures are growing. Yes. I mean, needless to say, we are almost in a war economy, and definitely the defense industries are involved, the primary industries to be involved in this race for defense and protection. Now, we should also consider that most of this investment is not necessarily in weapons. Mm-hmm. There's a lot of digital infrastructure, new technologies. So maybe in the future we will have to reconsider how we evaluate the investment in defense, in that it is not only weapons or armored systems, but will be also digital infrastructure, supercomputation, cloud, artificial intelligence, cybersecurity, space. Those things not necessarily have been included so far into the true defense investment, but very likely in the future this will be the case.
We have discussed in the past several times about, the future of Europe, the importance of euro. You have been, working as a minister before getting the CEO job. Do you think we are somehow, President Trump is making a favor to Europe, accelerating what you have been advocating for a while, the need for a cohesive defense common system?
Honestly, I don't think anybody is making favors to anybody else in this moment. There is an interconnection or an overlap of economical and financial issues and military and defense and global security issues. Sometimes the situation is a bit confused. For instance, applying tariffs made a shock to the market, but if we see in defense, the impact of tariffs is relatively small. And especially for Leonardo, having local production in US and local sell in US. On the other hand, I understand the argument that there is an imbalancement in the trading situation between Europe and the US, but this economy shouldn't be defense. On the other hand, I believe that the actual situation that has been created in Ukraine after the Russian invasion made clear that, first of all, Europe is too fragmented. So even though we have maybe 1.5 million soldiers in Europe, those are fragmented into 27 armies. We have many fighters, many tanks, many helicopters. We have so many defense platforms that in the end of the day, we're not very effective in the investment of our defense budget. The second thing that I think we should be noticed that no country can make on its own at European level to support and defend Ukraine. So clearly that was a bell. We have to wake up, we have to create a sort of European defense space. We have to boost the collaboration among defense companies. I mean, creating giants. I mean, if you see how big are the American and Chinese defense companies, they're much bigger than the biggest European ones, including Leonardo. That means facilitating the aggregation. That means favoring the synergy. Sometimes from the industrial point of view, this means making choices and making priorities very clear. So this is happening. And in view of the NATO alliance that I believe should stay, should remain, should be reinforced, it is very important that Europe gets stronger and that we need to be a solid, more reliable partner in the NATO alliance as a continent. And this will make NATO stronger and ultimately will make for the Western countries life safer in the future.
Leonardo CEO Roberto Cingolani speaking to our colleagues there about what is happening in terms of the defence space. And we stay on that topic because one of Europe's biggest makers of AI-powered drones has recently raised 160 million euros to help the company go global. German-based Quantum Systems is backed by the likes of Hensoldt, Airbus and PayPal co-founder Peter Thiel as well. Its co-CEO Sven Kruck joins me now. Sven, thank you for taking the time. We were just hearing there from the CEO of Leonardo then talking about how fragmented the defence space is, how there are so many different defence platforms. What is the strategy for Quantum Systems in terms of how you are trying to position yourselves within what feels like an increasingly saturated drone market?
I mean, it's great to be with you. The nature of warfare has changed. I think that's the situation we have to focus, and that's why the time for new defense is coming up now. So the topic of manned and unmanned systems and the relation to each other, that's the shift we are going through. And that's why we are, as a drone company and many other drone companies, will fill this gap of the new nature of warfare. And that's where we also take our spending from the Series C round to get this done, to get global and to be still in the lead of the new defense economy.
And I should say, there are drone makers and then there are drone makers. You're backed by Balderton, by Hensoldt, by Airbus Defence, by Peter Thiel. You've raised, a little over 310 million euros. What are the growth priorities, Sven, for you right now? Which regions, which segments, and how many customers and clients are you signing at the government level and at the commercial level?
I mean, we are all global right now. So we have locations in LA, we have locations in Brisbane, we have 150 people in Kiev around. So we want to tackle the world more, also going more to the Baltics. European sovereignty is a key issue at the moment. Europe has to understand who we want to be, how we want to defend Europe, and we will fill in our stake into this new defense economy here in Europe. That's our priority number one. Priority number two is really scaling our AI capabilities on our drones with our partners, as you mentioned, with Airbus and with Hensoldt. So that's the second point. And the third point is really, getting up speed. We heard it before with the Leonardo CEO. We have to increase. We have to speed up. And for speed, you need money. You need really people. So we have to increase our R&D capabilities. We have to increase our capabilities on hardware and software to make our family of systems on the hardware side, on short-range reconnaissance, mid-range reconnaissance, long-range reconnaissance, plus AI, plus software, getting ready for our customers around the globe.
Sven, how far does that sovereignty push go? Do you build systems that are essentially ring-fenced from US technology? Do you go that far? Or presumably you're still reliant on software and hardware from the US. And on China, is there anything within the Chinese supply chain that you rely on?
No, we are NDA compliant to take the terms from the US. So that means we have no Chinese parts in our drone. I think that's essential, especially in this time we are now, to drive European sovereignty. And that's point number one. But from the software stack and from the AI stack we are building, this is a European, so it's ITAR free. So it's coming from Europe. It's coming from our headquarters where I'm sitting here right now, here next to Munich. So we don't have any issues on that. And I think that's key. I mean, that's why we have chosen also these investors now with Balderton in the lead to really drive the European way and to get this done, what has to be done. And if you see the spendings in Europe, which are increasing right now, especially in Germany, going up from the GDP spending for defense from 56 billion up to 200 billion, then you have to be here. You have to create all the AI and the software and the hardware stack here on the ground and get this done.
And to be clear, briefly, you are seeing the impact of that defense spend increase?
Yes, we can feel it. I mean, it took a long time, and I think we really spearheaded and really pushed our politicians here on the ground all over Europe. As you maybe heard last week, we won the tender in Spain. We won a tender in Romania. We are leading here also in Germany. And I think we pushed it quite a while that we have to increase and we have to wake up. I think it's more than a wake-up call. Europe really has to understand who we want to be, and we can see it. So there's a huge increase of numbers. Our tender and systems numbers and quantities are doubling and even more. So we are ready, and also the militaries and the political side seems to be ready. And now we have to bring this triangle together between politics, military, and industry, and then we will get there.
OK, that's not always an easy triangle to bring together, is it? Quantum Systems co-CEO Sven Kruck, thank you very much indeed. Really appreciate your time this morning. Now to the luxury space, switching focus pretty dramatically. Switzerland's Richemont has reported full-year sales growth just below estimates amid its turbulent time, of course, for the wider luxury sector. A turbulent time. Charlie Wells is here with an update. Charlie, what stands out to you from these numbers?
Tom, so there had been really high expectations going into this report for Richemont because we've kind of been seeing this divide over the past couple months in the luxury sector, where you've got these sort of hard luxury companies like Richemont, which sell, jewelry, watches, kind of more durable goods. And the market has liked what they've seen from these companies. There's this sense that even in times of uncertainty, these kind of harder luxury companies do well. The softer luxury companies, the more fashion-oriented, the Kehrings, which has got Gucci, of course, the Burberry, they have not been doing quite so well. So I think what's interesting here, what we're seeing in some of these early numbers is a little bit of softness coming out of Asia Pacific. So you can see that so much of their revenue comes from that market. And of course, there's been softness there, particularly in China. So that's a big focus on kind of how that could be changing demand. But we're seeing pretty strong revenue coming in on the European side, on the America side. And there have been questions here about pricing. How much pricing power does Richemont have? They they target that, ultra wealthy consumer, so might have a lot of power there. I think some of the issues that we're going to want to dig into in these numbers is the price of gold. That, of course, has been on a tear recently. That makes it a little bit more difficult on the margin front. And then currencies, right? Because we've seen this dollar weakness. The U.S. is a really important market for them. But when they convert those earnings back into either euros or francs, that weakness hurts them.
OK, Charlie Wells, the Bling King, on these Richemont numbers. Thank you very much indeed. Breaking down the earnings with that focus on China and the input costs around higher gold as well. There's plenty more coming up. Stay with us. This is Bloomberg.
Volatility could be good or bad depending on who's facing it. So, but I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and the volatility itself will calm down.
Jamie Dimon speaking exclusively to us at the JP Morgan Annual Global Markets Conference in Paris. You didn't see a lot of volatility, talking volatility, in the session yesterday on the S&P 500. But what you did see, which is encouraging to some at least, is an improvement in terms of the breadth story. For so long, we've talked about the narrow nature of the gains that had come through for the S&P 500 before, of course, Liberation Day in April. Yesterday, the session showed that there is a move to broaden out the gains that we've seen for an S&P 500, of course, is just 4% below those record highs. These were the gains that came through yesterday for the broader index, but the upside was really felt in segments like real estate, utilities and consumer staples, and for some, that is a positive sign in terms of the momentum going forward. Let's flip the board and have a look on expectations as well around how this changes the trade conversation, or at least how the trade conversation is feeding into that story, because we've done some analysis, the Bloomberg team, around expectations for where tariffs land. They're currently at 30% now on China, having been reduced dramatically, of course, from 145%. The expectation from the analysts that we've surveyed suggests that that continues that level, 30%, for at least 6 months. Then maybe you get to 20%. There's that 90-day period, of course. That is still a significant tariff imposition on those exports of Chinese goods into the US, with all sorts of implications still, of course, for inflation and for what happens in the trade piece of the Chinese economy. So that's just something to bear in mind. Let's flip the board briefly and check in on the US recession odds then, because, of course, that is a central part of it in terms of the trade tensions with China. JP Morgan saying it's still about 50-50 in terms of a potential recession for the United States. Markets have started to adjust in terms of the poly market price, and the odds reduced their expectations to around 35% from 65%. 35% on poly market versus 65%, largely, of course, on the back of that easing of tensions between Beijing and Washington on recession front. Worth noting, of course, the data yesterday was pretty challenging, whether it's those prices paid into producers or the retail sales number that came in softer as well. And we know the soft data out of the US has also pointed to pretty significant cooling. So the debate around recession risks remains. Coming up in the next hour, the deputy head of the president of Ukraine's office joining us for an update on the Russia-Ukraine peace talks in Turkey. But the opening trade is up next. Stay with us. This is Bloomberg.